Hello everyone, welcome to FiSC CAPITAL. Today we are in the fourth episode of Warren Buffett Lectures. As you know, in this series we decode Warren Buffett's timeless strategies on stock market investments through his letters to the shareholders. In 1960, as usual, Warren Buffett started his letter by giving a general overview of the stock market. So he mentioned that the Dow Jones Industrial Average, after a continued rally for a couple of years, went down by 9%. Adding dividends back, the return was around 6 to 7%. At the same time, since utility stocks were doing well, that's why the big mutual funds and other peak funds of that period performed better than Dow Jones. Here, this approach which Warren Buffett was mentioning, that we should always look for long term and a small return deviation or underperformance in the short term against indexes shouldn't worry investors because the funds always take some long term approach and companies take time to prove and justify those confidence. Warren Buffett also mentioned the returns of his partnerships for the year, and it was a net profit of around 22%. Compared to the index, it was significantly light. And if you look at the last 4 years, the total return from Dow Jones compounded return was around 40%, whereas for me, Warren Buffett, it was close to 140%. Again, Warren Buffett has highlighted that he is not always looking to beat the market. He rather focus on matching the market when index is in bull run and try to outperform it when index is in bear run. So what he wanted to say is that rather than scoring 240 on a pitch where average score is 230, he focuses on scoring 230 on such pieces, but wants to score 170 where the average return is 130 or 140. Now, his main investment from last year, there we were talking about a holding company having 30-35 stock portfolio, has given the desired return he wanted. He now was able to openly talk about this stock, which he wasn't able to do last time. So the stock which he mentioned was a company which used to build map. It was called Sanborn Map Companies. They basically had an approach where they create a map for any particular city and use pasting technique to update the map further and further year on year based on the development of the city. So the cost of updation wasn't much, and a same map can be used for next 15 to 20 years until there is no longer any scope for besting, and then the company starts creating the maps. These mapping techniques and these maps were very helpful for the general insurance company who used to look at these maps to decide whether to give any particular insurances in a particular area and minimize their risk. Now, the business of Sanborn was quite growing and insurance companies were their biggest client. However, insurance companies were worried that Sanborn may become very big monopoly in this business. They may have a dominance over insurance company related to pricing. To avoid this, insurance companies started putting more and more leadership of their companies into the boards of Sanborn. Now, in recent years, around 1955 to 1960, a new technique called cardiac started catching up, and the business of mapping was no longer as attractive to insurance companies. Therefore, Sanborn started losing the leadership and value it was having once in 1930s. Here, Warren Buffett identified that in 1930s, the stock price of Sanborn was $110, whereas their investment portfolio was $20. And that means the company business was given a value of $90. At that time in 1930s, as I already mentioned, that the cost of vesting was much lower. Therefore, Sanborn used to have enough cash reserves, and therefore they have started buying stocks and in bonds in 50-50 proportion to have a good investment portfolio. This portfolio rose to $65 valuation, 1958, 1959. So at that time, the valuation of their portfolio was $65, but the price of the stock was $45. So basically, investors were paying minus $30 for this deal. Now, obviously, no business keeps returns at $0 cost. Second thing was like the resources and information Sanborn used to have in these months. They were quite regular. So Warren Buffett knew that this company also has a good business model and they can have a sustainable business even in the sense of being a very big player for the insurance companies. So he basically wanted a position in this company, but he to achieve the goals he actually wanted to achieve, he had to have a powerful stock position so that he can be part of the board. So he started acquiring stocks as much as the total investment in Senbon of his all partnership was close to 35. During this time, he also used some opportunities to buy some former presidents and founders stock, and he also realized that although many big directors of insurance companies were board of directors for this same one stock, these people did have much position as a shareholder. So Warren Buffett joined other big shareholders of the company, and all of them decided that we should carve out the business in two halves. One will be the investment portfolio, stock portfolio of Senbot. Other will be the core business plus bond portfolio of Senbot. The small portfolio will work as a cash reserve so that company can decide on their future growth strategy. The stock portfolio obviously is going to be an isolated holding. So Warren Buffett decided on this since he was the biggest shareholder. Joining the others, they become majority shareholder and approve the decision of demerger. Now, as demerger happened, obviously the value unlocked for both the sides of businesses. Warren Buffett and his partnerships earned good profits. Now we have to understand some aspects here. The main thing to understand here is from a general or a market overview, if you see some deviation in your portfolio in the short term and you feel that somebody else is performing better than yours, then you should not worry if you are quite confident on your strategy. And the second learning from this case is understanding the power of holding companies and investment in them. Because many times, even today, you can see that some holding companies are quite undervalued in terms of the valuation they have based on the holdings there. Take the example of FiSC investment, which was very recently highlighted because they used to have a very huge position in Asian Paints, which makes their per share price equivalent to 5 lakh rupees. But the stock was selling at around 3 rupees. Another thing which you have to understand in investing in such kind of concentrated position is that Warren Buffett took this concentrated position because he wanted to be a catalyst for this demerger. In today's scenario, we generally don't have this much capital that we can actually become the catalyst for such stocks and unlock their value as soon as possible. So I see a lot of people doing having a very concentrated positions in their portfolio. They want to buy 5 or 10 stocks or 15 stocks and build a portfolio. There is nothing wrong in that, but until and unless you know a lot more about these businesses and you are very confident of their performance, it's always better to have more diversify your portfolios so that you won't rip your investment and put your copy capital in some companies which won't give you substantial return in small period of time. If you like this video, please share this with as many people as you can. Don't forget to subscribe our channel for more content like this and do let us know in comment if we can do anything better than this. Thank you very much.